Okay, good morning guys. So, welcome, first day of the month, final month of quarter three. Just showing you a chart of the S&P here. The meteoric rise of the US stock market. We're kind of still flagging a little bit. We hit 2000, well, you can go back to the 25th of August now. So we've been up here. This will be the the sixth session in a row that we've been really just flirting with this key psychological barrier that is the price point of 2000. We've been trading that again today. It's not really operating necessarily as an exact technical level. We've been up through it pretty much on each of those 6 days, but it's an area where you're seeing a little bit of exhaustion from what has been an impressive rebound here, having had that decline end of July, start of August, mainly off Ukraine fears, a bit of US tightening monetary policy risk, but ultimately we've launched to 2000, so it's quite an important week, I would suggest. That's going to really determine whether or not 2000 and above is justifiable for the lead stock market of the world, or whether this is high enough for now and we're going to need to see a little bit of a pullback. But this is the 1st of September. It is actually a bank holiday in the US today. It's Labor Day bank holiday in the US, and so certainly this will affect things this afternoon in a negative way with regards to volumes, so it's likely to be a quiet afternoon to say the least. But we do have a lot of key data. We've had some data overnight. We're going to have some more data this morning. But I just want to point out there is an old saying in the city of London, and that is, the saying is, go away in May and come back on St. Ledger's Day. Well, this is an old adage that basically points towards the fact that during the summer months equity markets tend to underperform, so you might as well just sell up at the end of May and go away for a couple of months, few months holiday, come back on September and get back invested. And there's a kind of weird pattern. If you go back over the last, well, I don't know, 100 years, for example, then by and large this technique, this idea actually means that your overall performance is pretty impressive. However, of course, this year it's certainly not been the case, especially when you're looking at US stock markets. If you'd have sold up at the end of May, let's see here, end of May we were trading about, here I'll be generous, we're trading around about 1900, and here we are at 2000, so we are 5% higher. So if you'd have done your sell in May and come back on St. Ledger's Day, you'd have lost out on 5% of upside. Now obviously more than 5% of that has all come in the last 3 weeks, because we were trading, if you go back to the 8th of August here, we were trading below the end of May levels, but it's all come in a final burst into the end of August. So I think it's quite a pivotal week. What I want to do is just talk about the week ahead, because it's packed full of data. I'm going to bring in the calendar for the week here, and we're just going to have a quick look through this. This is today's calendar in terms of data flow. Now it's full of manufacturing information flow this morning. We're not getting any data this afternoon because of the US bank holiday. Now we've had Chinese data last night. Chinese data came in and it was actually a little weak. There wasn't too much in it, but the manufacturing numbers from China, both, they kind of have two readings, which makes it a little confusing, but they have the official government manufacturing PMI, which is really measuring manufacturing sentiment amongst the large cap, mostly state-owned manufacturers, and that data came in slightly lower than the previous month. With these PMI numbers, anything above 50, remember, indicates that the manufacturing conditions are favourable for an expansion of output. Anything below 50, then we got contractionary conditions. So the headline manufacturing number from the government, looking at the state-owned large cap manufacturers, came in at 51.2, which was down from 51.7 from the month before. The second manufacturing reading we get from China is the HSBC manufacturing number, so you can see that here. That was released at 2:45 a.m. and that came in at 50.2, or sorry, actually it came in at 50.1 rather than 50.3 that was expected, and same as last month. So what you've seen in China with regards to manufacturing is that we've seen a very, very marginal drop. It's still both numbers above 50, however. But if you're looking at how China's government have a 7.5% GDP target for 2014, while manufacturing PMI numbers that are only a whisker above 50 aren't going to deliver the kind of growth rate that the government is looking for. So there is an argument to say that whilst these numbers are marginally weaker, at least they're still above 50, and it most certainly, well, you would expect perhaps the Chinese central bank to ramp up its monetary policy stimulus efforts in order to lock in a 7.5% GDP growth rate for the year. So we may expect some further stimulus. We've seen some targeted stimulus from the central bank of China earlier on in the year, but it looks like this isn't really having as large an effect as the government might want, and so you may well see that we get further stimulus. We actually had a pretty good Asian session last night. The Shanghai Composite was up 0.8%. That's on top of the 1% climb that we had on Friday, and so traders have mostly taken this news positively, with the idea that perhaps more stimulus might be forthcoming. Now we're going to get data from Europe on the manufacturing front this morning. We're about to get the Italian manufacturing PMI numbers at 8:45. We then get the more important French and even more important German figure at 8:55, with then the Eurozone as a whole coming at 9 o'clock. As you can see on the... Actually, no, sorry, I don't have the forecasted figures there for you. So on this screenshot, yeah, for some reason we don't have any forecasted numbers here for these lot. We had the Spanish data already. Spain's numbers came in at 8:15, and that was slightly weaker than expected. So Spanish manufacturing PMI for August, 52.8. We had expected 53.3, and that's a drop from last month's 53.9. So Spain first in terms of the big four Eurozone countries, and slightly weak. So whether that's going to point the way for the rest, we'll have to wait and see. Italy are coming in 5 minutes. Their reading last month was 51.9. You know, the manufacturing conditions are really important. It's an important guide. These are soft data. This is forward-looking figures. This is a survey. It's not measuring actual output. This is actually just surveying CEOs of the big manufacturing firms and assessing their thoughts on conditions for their business going forward for the month. And so this is a forward-looking indicator. And you know, the Eurozone has been struggling this year, despite so much optimism about the Eurozone in 2014. It just hasn't happened, and we've had the likes of Germany slip back into a contraction in their GDP in Q2. Italy are in recession. France don't have any growth whatsoever, and haven't had any growth for 12 months. It's really only Spain out of the big four here that have actually had decent growth this year, and perhaps that's an indication of what can happen if the government actually delivers some meaningful economic reform, which Spain have done, and perhaps this is the evidence that they're starting to see the benefits with relatively a much better performing economy. So manufacturing data through the morning. Germany the most important, of course, being the biggest economy in the Eurozone. Also, Germany being so dependent on manufacturing. From an export point of view, Germany's GDP, about 50% of German GDP is attributed to exports. And perhaps this is why we've seen Germany, German markets being most heavily affected by the Ukraine situation and the geopolitical situation. We had the EU leaders meeting over the weekend, and there is appetite to increase sanctions on Russia. There's appetite from core Europe But Eastern Europe is, as you can understand, is a little bit hesitant to join in and give the green light here. Of course, Eastern European countries, I mean, we talk about Germany being exposed to Russia, but of course Eastern Europe are much more exposed, and they're smaller economies, and so there's a little bit more reluctance from the Eastern European nations. But we have had developments over the weekend with Putin. While he's calling for statehood talks, as he's described it, statehood talks on southeast Ukraine, and really suggesting that, well, I guess like the Crimea, which annexed themselves through a referendum that was disputed by the West, but still the referendum took place and they voted to detach themselves from the Ukraine. And it may well be that Putin is angling for this is his end game for eastern Ukraine, perhaps. We have, of course, seen a step up in military activity from the Russian rebels last week, at the end of last week. This is where it's believed the rebels are being supported by Russian military in terms of personnel, but also military equipment, and they've made back some of the lost ground. The Ukrainian army has been very much on the front foot for several weeks, until the end of last week, where there's a little bit of a fight back that's thought to be aided by Russia. So this Ukraine crisis will continue to dominate headlines as we go through this week, you would imagine, but at least this week we're getting a lot more key data flow. Let me scroll through the week quickly and show you what other data we've got. Let me just maybe zoom in a little bit on this so you can see it a little better. So here we're moving on to Tuesday's session, and we got we got plenty of Australian numbers overnight. We had Australian CPI data last night, which dropped, which is a relief. Inflation got up to 3% in June, and there was talk that perhaps the central bank might have to do something about it, but inflation levels have dropped back lower in Australia, back down to 2.6%, and this has just given a little bit of relief. And you know, we can't, interest rates are still very low in Australia. There was a fear they'd have to start rising them due to inflation, but inflation's pulled back, so that's a positive. That helped with the Asian session last night. But tomorrow we're getting UK construction PMI numbers. We've got Swiss GDP in here as well, Spanish unemployment. But in the US session, because they've got a bank holiday today, we play catch up and we get the manufacturing data from the US tomorrow. So this will dominate tomorrow afternoon's proceedings. Very healthy ISM manufacturing number for July of 57.1. We are expecting that to pull back slightly, but of course key data set from the US this week, as is always the case first week of the month, building towards non-farm payrolls on Friday. Let's just scroll down. Here's Wednesday's session. Very busy. Wednesday's all about services PMIs. Today, first of the month, we get manufacturing. 2 days after that, we get services. So this is obviously important for all of these economies. The services sector certainly making up the bulk of developed market economies. We're about to get the Italian manufacturing PMI announced, by the way, so I'll report that as soon as it comes in. Due right now. 49.8. So that's weaker than expected, and actually it's also below 50. So that's back into contractionary conditions. I guess you shouldn't be surprised by this, given that we've had weak data out of Italy generally. We had a surprise drop back into negative GDP for quarter two, and it looks like quarter three, because we're two-thirds of the way through quarter three now, it looks like quarter three is going to be a little bit damp as well. But here, back to the calendar for Wednesday. Services PMIs, we get some GDP data out of the Eurozone as well. This is for quarter two. And then into the afternoon we get US, ISM. We don't get services numbers from the US until Thursday, I believe. So we get factory orders numbers, an ISM number from New York, as well as some oil data. If we go down to Thursday, then it starts hotting up a little bit on Thursday with regards to data from the US. Before that, we get German factory orders that are always very important. We've got the Bank of England monetary policy meeting, which we're not expecting anything from in terms of change to policy. We get the ECB's Interest rate announcements at 12:45. The ECB got their monthly policy meeting as well. We get ADP employment change from the US, looking at job growth in the private sector. We've got initial jobless claims also, but then topping the bill, despite all of this key data flow, topping the bill will be the 1:30 press conference where Mario Draghi, the president of the ECB, sits down and discusses his current thoughts on economic conditions and, more importantly, what's he going to do about the deflation risk. We've had another drop in CPI, or at least headline CPI, last month, although I'm sure he'll be quick to point towards the fact that core CPI stayed flat or actually increased marginally. This should give him the breathing space to not have to act at this week's meeting and roll out more policy. There are growing noises from market participants that Draghi shouldn't be waiting. He should be implementing more stimulus packages now. I don't agree with this. I think he is going to wait, and I think that the press conference at 1:30 on Thursday is going to really be one of the most important events of the whole week. And then finally Friday, to wrap off the week, plenty of data, but there's really only one that's of any importance, and that's at 1:30. Change of non-farm payrolls, the amount of job creation that was seen in the month of August right across the US, apart from the agricultural sector. So this is looking at public and private sectors. We've got a reading of 220 is the current forecast, which will make it the seventh. I mean, if it comes in above 200, it will make it the seventh month in a row of plus 200,000 job growth. And this will continue the theme that the US labour market is nicely recovering, and this is propelling positive economic feelings towards the US. So if we just flip back to the S&P chart, all of this data that we've got coming through the week is really going to determine whether or not 2,000 is a justifiable price point or not. And you've got to guard against the fact that if the economic data from the US does come in really, really, really strong, well then there's that monetary policy negative, because will it mean the Central Bank of America have to raise rates earlier than we currently think? And remember, we don't currently think they're going to raise rates until, well, perhaps earliest April next year. But if we continue to get very, very strong data, then yes, of course, that's a positive from an economic point of view, but you could argue also for a stock market valuation, it's a potential negative, because we might need to start pricing in earlier rate hikes, and initially, certainly in the short term, rate hikes are bad news for stock markets. So it's not going to be immediately straightforward, I don't think, the reaction on equities when it comes to data out of the US this week. Let's have a look at the euro dollar here and just have a look at the currency situation, because this has been a phenomenal move in the last couple of months. Off the 140 top start of May, here we are right the way down, almost down on the 131 handle for euro dollar. It has been a capitulation is perhaps not too strong a word, and we've got a key reference point here, and we're just about to get some French manufacturing data. We've just had the Italian numbers a minute ago. I'll give you these French ones when they 46.9. 46.9. Wow, that's weak, to say the least, for French manufacturing numbers. 46 actually, I'm just checking in. It is actually slightly higher than last month's 46.5, so it's not quite as desperately bad as that number suggests. It's so far below 50, obviously. But actually, yeah, that is better than expected. Okay, fair enough. So France still languishing well below the rest, but I guess the optimist within you might look at these numbers and say, well, it is better than expected, which is one thing. So, but back to the euro dollar here. It's an important week for the euro dollar, because really Draghi's got what he's wanted here. He's been screaming for a weaker euro really for the first half of the 2014, and he's got it in spades here. We've dropped 900 pips in the last few months. This is not small movement, and so the 131 handle is important. That's the September low from last year. So here we are, September the 1st, 2014, and we're about to test the start of September levels that we saw in 2013. So key technical support here. Should that get breached, then we got some levels. We got a 50% fib, and the 130 handle would be next up in terms of key long-term support, before we then look down at 2013's double bottom at 127.50. So can Draghi be dovish? I mean, if he doesn't deliver more policy, more stimulative policy this week, which many are asking for, if he does not do that, are we going to see a rebound in the euro? Or can he be dovish enough in his press conference to continue to, well, keep alive the dream that his promise of quantitative easing is still believable? So he's got an important job on his hands to keep the euro under pressure. Of course, we can get dollar strength this week. Certainly, if we get a strong set of data out of the US this week, and if it's really strong and we start bringing forward our rate hike expectations, then certainly there's more dollar strength that's possible in this currency pair. But if we can get some dollar strength and euro weakness of a dovish Draghi, well, then we can certainly break down to the 130 handle. Of course, though, if Draghi doesn't roll out any more stimulus, which I don't expect him to, and he's not quite as dovish as we would want, and we get some weak US data, well, then there's equally scope for actually a pretty large rebound. We've come a long way in a short space of time to the downside, and a rebound back to the 133 handle wouldn't be impossible. That's a key resistance point. That's not impossible given how far we've dropped. So it's an important week for the currency space, particularly for the euro. So that's it from me for now, guys. We've got German manufacturing data that's due to hit the wires in 1 minute and 30 seconds. It's an really interesting week, packed full of important data: manufacturing, services, PMIs. We've got key labour market data from the US, and then we got monetary policy meetings from the UK, and more importantly the ECB, and then on top of that we've got the ever fluid and live geopolitical developments, with headlines sure to come thick and fast out of Ukraine. So we've got to try and negotiate all of this and determine how this is going to shape asset price movements. So it should be an interesting week. Alright guys, enjoy. Thanks a lot.